I'm frankly surprised by the strength of the markets, and I'm surprised by the strength of the global economy. Given that the global economy has been a very long time without a recession, and given the fact that the global economy has had to deal with the shock of higher interest rates and the shock of at least a political war, I am surprised by the strength of the economy, basically every economy on the planet, and I'm surprised by the strength of the markets. Kai, as you've known me, I'm a fairly cautious individual. I'm a credit analyst, which means that I focus on getting paid back. And people like me are normally cautious. I joke that between Doug Casey and I, we have called absolutely accurately 17 of the last 3 declines. So certainly my outlook is cautious, but I have to say that the strength in the economy, even in the face of higher interest rates and a higher cost of capital, has been a real surprise to me, and frankly, a very pleasant surprise. I had expected much more trying times in 2023 than I've experienced. I would agree with that. I'm nervous that the economy will perform the way it did in the first decade of the 1970s, the first half of the decade of the 1970s, where the economy in the early part of the decade of the 1970s was able to stand both inflation and higher interest rates. But then the impact of higher interest rates in particular was felt in the middle part of the decade of the 1970s. Again, I'm not an economist, I'm a credit analyst. And I make this up, Kai, perhaps to explain circumstances that I don't understand fully. My nervousness is that the impact of higher interest rates will be a delayed punch. As an example, in the United States, despite the fact that 30-year fixed mortgage rates are up by more than 100%, you aren't seeing widespread decline in home prices. What you're seeing is a broad decline in volume, which is to say the buyers aren't willing or aren't able to pay as much as they were willing to pay 2 years ago. But the seller's expectations are sticky. There's bigger gaps between the bid and the ask. I guess that resolves one of 2 ways, up or down. My nervousness is down. But again, I'm not an economist. I'm a lender. And so perhaps my worldview is shaped by what I do. The job market is incredibly buoyant. And I take some solace at that. It's interesting that the job market is buoyant only in 2 sectors, though. Low-wage service, where unskilled or semi-skilled workers generate such limited utility that they can't be paid living wages. That's booming. And then the highly skilled sector, the sort of 150 to 350,000 a year jobs that generate a lot of utility that require a lot of expertise. The incredible strength that we have seen in the highly skilled sector, the fact that, as an example, Silicon Valley can take 10,000 layoffs from some of the tech giants and absorb those workers in 6 weeks has really impressed me. I'm impressed, too, with the durability of the job market in finance, both in equities and in credit. I would have expected Wall Street, in terms of hiring, to be much softer than they've been, but that hasn't been the case. I live in rural Northwest Washington, and the little community that I live in is experiencing such extraordinary labor shortages that, as an example, Safeway is paying people $20 an hour to start. The police department is paying people a $7,000 or $8,000 signing bonus, or a $30,000 bonus for a lateral transfer. There may be recessions in subsectors and in some regions, but I'm incredibly impressed with the strength of the economy, and not just the U.S. economy, the European economy. challenged by much, much, much higher social and energy costs, and challenged too by what, if it isn't a war, is a very ugly police action in the Ukraine. I would have expected the Eurozone to be in much worse shape economically than it is. Even Germany seems able to afford hyper stupid energy policies and appears to discount the challenges on its eastern and southeastern border in terms of sentiment. So I need to say that I, thus far, with regards to my own excessive cautiousness, have been wrong. I think that may be the reason that gold is hanging in there. I think the reason that gold hasn't soared, frankly, is that we were schooled by 40 years of benign economic climate, beginning in 1982, and I would suggest ending in 2022. So I think that confidence is quite high. While I'm attracted to the performance of the broad economy, I am not attracted, but rather terrified when I look at collective, which is to say government balance sheets. We've talked about this on your show before. The strength of the U.S. economy has not translated into covering the budget deficit, as an example, or dealing with the debt. And that circumstance is the same in Europe. I think that increasing nominal interest rates has made short-term deposits more attractive. And I think that that has detracted from acceptance of precious metals. But I think a much more important reason is that because all of us were schooled in terms of our investment performance and expectation by 40 years of benign economic climate, which is to say we've been schooled not to become scared. I may be excessively scared, but when I look at gold and I think about the fact that, as you say, it's, quote, held up, I am really surprised that it hasn't gone further faster. When you talk, as an example, about real interest rates, understand that I would define a real interest rate as a rate paid as rent on savings that exceeded the depreciation of the currency that the savings were denominated in. And the measures of inflation, I think, are very misleading. As an example, when it suits them, they describe core inflation, which doesn't include food or fuel. As your listeners can tell by looking at me, I like to eat. And so that definition of inflation doesn't apply to me. But two, when they talk about CPI, Consumer Price Index rate of inflation, they're really trying to construct a cost of living index. And the fact that inflation doesn't include the cost of government, which is to say tax, which consumes more household income on average than food, energy, shelter, and travel combined, you truly have a fallacious index. And I guess that one of the things that has, I think, kept down the gold price is that consumers and investors and taxpayers have come to allow their interpretation of inflation, to be shaped by what is frankly a fraudulent method. When I look at the impact of increased taxation and the certain threat of more rapidly increasing tax on my budget, I understand that the stated measure of CPI has in no way measures my own cost of living. Now, Kai, if I didn't have to pay the tax, I probably wouldn't complain so much about the index. But I suspect that very much like in the 1970s, as people come to understand the impact of the deterioration of the purchasing power of their savings, that people will become less wedded to interest yielding savings products and more interested in investments that traditionally have offered better shelter from inflation.
Well, Powell reiterated his 2% target for inflation. Since we're on that topic, I have to I was going to say
Fiction.
I have to follow up on that, right? So, like, how
It's
much
total
pain
fiction,
do we
but
have to see to get to that?
But you have to measure. You have to measure how it's measured. Their 2% number works as long as people believe their inflation measurement matrix, which is itself fraudulent. When people focus on that number 2%, they need to focus on the measure of constructing that index and how that impacts their cost of living. Imagine that you're a Dane and that 58% of your household income is consumed by government, yet your government continues to run a deficit. Imagine now that your savings in euro-denominated bonds are yielding you 2% in euro, where the after-tax purchasing power of your savings is declining by 6.5% compounded. What you learn as a Dane is that your savings are costing you 4.5% of purchasing power a year, and you're ignoring the largest single factor in the depreciation of your purchasing power, which is to say increased taxation. I'm not saying this merely as a political statement, Kai, although I do like to propagandize. I'm saying this because people pay attention to easy to grasp headline statistics like a 2% inflation target. The problem with a 2% inflation target is that the measurement matrix that people are accepting is fraudulent. I see a huge chance of that happening. And I think that the policy response to a deflationary shock would be quantitative easing and government borrowing, which is to say, ironically, the policy response to deflation would be extremely inflationary. Again, we saw that in the mid-1970s. In the mid-1970s, we decided to raise interest rates further to combat inflation. That resolve lasted a sum total of 9 months, if my memory serves me well, before the political powers and, frankly, the voters decided to return to a policy of free beer and a free lunch, which couldn't last. Thus far, the economy has been strong enough that the economy has weathered the rate hikes. Now, let me be very clear, Kai. I wish there were no more Fed meetings, ever. And I don't expect them to accomplish, at least on purpose, anything good. I think that you're in a managed economy, and I think an unmanaged economy would be better for all concerned, albeit more volatile. I do think that the Fed has a sense of what real inflation looks like, a sense that's probably absent from the average household. And I think that the Fed is genuinely concerned about controlling those aspects of inflation that it can. If that's true, given the relative strength in the U.S. economy and the incredible strength in the bond market with negative real yields and the relative strength in the equities markets, I think that they have the opportunity for a 25 basis point increase. And I think that they will probably take it.